Good afternoon to all. Welcome to our second episode of Friends with Benefits, wherein we reach out to professors to hold a discussion to know their opinions on the latest topics, issues, and trends relevant to the current financial market. Let me introduce to you all the members present in today's podcast. Professor Filorisco, Director of Hanlon Financial Systems Lab, and Professor Majid Saman, Assistant Professor of School of Business at Stevens. He did his PhD in finance, and his research revolves around risk management. So without further ado, let's start with today's podcast. So Professor Saman, I believe this would be a question that everybody would want to know about. Should beginners invest right now when the market is so volatile?
Yeah, so that's a great question. So I actually been talking about this research for a long time. One issue is basically there's a view about people cynical about how much you can time the market. And recently, I saw a very interesting docu-series called Eat the Rich, the GameStop saga, and that's actually focused on retail investors. Eventually, you can see that actually most people who try basically time the market, as happened in 2020, those actually would suffer the most. So my recommendation, which is very boring recommendation to every retail investor, it's more time in the market, not timing the market. So I think you should basically think about a long-term investment that you also take into account diversification benefits, and you keep recurring investments. And this is actually something goes back to the investment philosophy in terms of sometimes you think about, I might need to lose.
Wait, so what is your recommendation? Sorry to interrupt.
My recommendation is do not try to time the market.
What does it mean, time the market?
Time the market is basically as you think that now we're reaching a dip, right? So the idea is philosophy goes, buy the dip, sell the rips. But the question is, who knows? After the fact, I can tell you a lot of stories. So in reality, you can't really time the market. I mean, some people get lucky timing the market, but as a retail investors, you're also very disadvantaged in terms of information, research skills, and other basically how much time you're spending in that, because we actually see that sophisticated investors such as hedge funds, who basically that's their full-time job, or other mutual funds, they actually, majority of them underperform the market. So my recommendation, which is basically is hold the index, such as the SPY ETF, and keep doing recurrent investment. And in 20 years, you actually will build whatever the market happens, volatile or down or up. You basically, by doing so, you kind of have some sort of assurance that actually will be able to buy something at a discount, but you keep doing it. And I think usually in the long term, we think about the market actually give you that risk premium. So if you're young, I would say that's my recommendation. You should keep investing regardless what happened, but avoid the timing of the market, because the timing actually can be painful.
So Dr. Siman, he teaches our risk management class, right? So that's his expertise. So of course, he's very concerned with risk. That's what he teaches in. So what the advice is, if I understand you correctly, rather than answering the question, invest now or invest later, it's more like, what do you invest in, right?
Yes.
So he's proposing, rather than investing in individual stocks like Apple and IBM and Twitter and whatever, which carry with them a larger risk, you would advise them to invest now, but in a diversified thing, such as an ETF. And the example you gave, right? It's what did you mention?
Think about it as most people, you allocate money to your 401, 403 pensions, right? So the way you do it is you allocate certain money every month. And that's basically the wisdom is, it doesn't matter what happened in the market, you're always allocating more and more funds. And in this case, actually, as you look at what most people add money as the pension funds, nobody's actually trying to time the market. The only timing is as soon as cash flows become available, you invest that. So that's actually what I do in terms of my own investment, because I'm full-time working as a faculty. And, there's a lot of stress being under the tenure clock and other stuff, and working with students, responding to students' emails and so on. So again, as soon as these funds become available, you invest them. And that's what we call a passive investment, because, I might be sitting in a $10,000 and trying to time it, versus as soon as I have $1,000 available each month, I would reinvest that. And this is actually my research where we considered it, because actually the research was called buy the dip. Should investors actually buy the dip? And this is a topic was very relevant because, a lot of retail investors, you look at the Wall Street bets, the whole Reddit group, Ape Wisdom, all that, discussions, and everybody was talking about using the hashtag, buy the dip, buy the dip, buy the dip. And the question is, should you buy the dip? So according to the simple back testing we did, what buying the dip does, anytime, let's say, there's a drop in the market and you purchase, so basically you can think about it different ways. I get a lump sum money and I put that as soon as the market drops to a certain degree. What actually happens is there's some benefits in reducing the risk-adjusted, enhancing the risk-adjusted returns. So what risk-adjusted returns mean? We go from point A to point B. The question is how we do it. Are we doing it in a roller coaster, right? Or we go in a smooth way? So high risk-adjusted return means we're going smoother from here. And if you think about it as we speak, as natural, as human nature, right? This one, so hold a second. So as a roller coaster, that comes with more anxiety. So better risk-adjusted returns means lower anxiety in your investment. Now, what is the other thing is, it does enhance your risk. Hold your horses. I know you want to.
No, but I need the clarification.
So, yeah.
Like, what are you're saying? See, this is somewhat for some sophisticated, this is not for like the layman, right? But nonetheless, if the students are watching this, they would like, I think, to know what the heck it is that you're talking about when you say risk-adjusted returns. And when you're saying, well, you gotta go like this or I go like this, that doesn't really mean anything, right? So,
unless you took my class, but that's a joke. Yeah.
So Dr. Siman teaches, like I said, our risk management class, and he writes. He's an active researcher. So we will post after this podcast under the link wherever the podcast is posted. We're gonna post two links to some of his papers. Particularly the one that you mentioned, Buy the Dip, which is, where was this published?
It's still work in progress.
It's work in progress.
Because if you want to write something to the public, it takes certain effort, but if you want to appease the reviewers, it takes a different kind of effort, but yes.
Right. So my question for you is, rather than going deeper into what it means to risk adjust, I mean, maybe just explain what is.
So risk adjusted returns basically think about it as humans, right? Eventually we think about terminal wealth, right? You have $1 million. So let's say I want to make this $1 million, $2 million. And if you go from point A to point B, and those become $2 million, that's fine, right? The question is, how was the transition from $1 million to $2 million, right? Did we go smoothly from $1 million to $2 million, or we went down to you lost 50% and then eventually recovered? And I'm sure a lot of us actually right now, I discussed the paper recently and I told them like the link between the macroeconomic and the stock market. And I joked is in order to understand what's happened, just look at your portfolios, because portfolio's been going down, the stock market overall is going down. And it's been a lot of anxiety in that market. And the question is, eventually I go from $1 million to $2 million. But the question is, how much uncertainty was during that period? So less uncertainty was, less fluctuation. It means higher, better risk-adjusted return. Make sense?
Yeah. So you're talking about Sharpe ratio?
Sharpe ratio is one example. Sharpe ratio would be a good example. And that's what we actually looked. We looked at Sharpe ratio, Sortino ratio. So Sharpe ratio would be a way to basically say $1 million went to $2 million, right? So we had that's 100% increase, correct? Right? Okay. So 100% increase. The question is how much fluctuation we had in our wealth, right? So the larger fluctuation is, we can think about we punish these returns. And this is something has to do that, typically we view as investors as risk averse. So anytime you have that, it actually becomes you have more aversion, and that gives you this utility. And think about yourself, right? Because if you get a liquidity shock where all of a sudden you have to buy something and you went down from $1 million to $500,000, right? So now you're 50% down. So the main result from our paper was, buying the dip actually does reduce that anxiety, right? But overall, you're not going to have maximum wealth. So it comes there's always an opportunity cost, right? Because you actually could have invested that money and that give you some exposure to that risk premium in the market, which overall is about 10%, right? But that 10% also fluctuates. Doesn't mean it happens all the time, every year.
So I want to further on this and basically maybe ask another question. So when you're talking about going from 1 million to 2 million, right? And you're talking about the fluctuations, that's when basically you're just looking at your investment, right? But I want to point out that, what if, for example, your objective is to go from 1 million to 2 million, but the market itself is going from 1 million to 3 million, and your investment is not really that good, is it?
Exactly, and that's a great point, because if you so let's say your benchmark is the market, and that's why I'm recommending is to always consider investing something in a passive fund. And we can see that a lot of active funds actually did outperform. There's a long literature, there's a long evidence that actually a lot of active managers underperform. And you can see now there's a lot of these big funds, the big asset managers, they're all going passive. They're all like utilizing robo-advisor, which basically that's the concept. Not timing the market, but rather they're just spending more time in the markets. Do not wait too much in cash, because you're missing out some the percent return. And that's why, again, when my friends brag about making money in 2020 because the market actually did rebound, and they always say I made 20% in my portfolio, and I say, yeah, that's true, but how much the market made? So that's when we think about relative performance measures. So not everything in absolute terms, right? So you think about it as, if I put my money in a very passive fund, how much actually that money would grow, right? So that's another concept. So that's how we benchmark our analysis, right? So we'll look at it from the perspective as soon as my cash comes, I'll put in the SPY. And the other hand, the SPY is basically standing for the S&P 500, the SPDR ETF, which is the most traded ETF. ETF means it's a basket that actually combines different stocks. So I don't have to buy individual stocks. I can just buy a single security that tracks from market. And in this case, it's actually, we could see that it's very hard to outperform that fund. And buying the dip, the only evidence we saw that buying the dip actually, it does reduce your anxiety, because in the end, you're holding more cash over time and you're buying when it actually goes. But again, the other problem is it's very hard to forecast where the market is going. And the reason is the market is tanking is because the market is still digesting bad news. And we can see talks about inflation for the last 2 years. Everybody's talking about inflation, and say like, okay, recession is gone, but again, there's another sell-off. So this is actually a lot of unpredictability, uncertainty, how the market digests that information. And again, the markets keep dipping could be a sign that there's more persistent bad news coming.
Okay, so let me, before we go into that, let me just kind of summarize what Dr. Majid said. And also I want to plug in my program in financial analytics. So basically, if I understand you correctly, right? Your advice is, well, if you're an individual investor, which is what you're calling retail investor, because Dr. Siman used all sorts of like fancy terms that me as a mathematician I'm not familiar with.
Yeah.
And so basically the advice is, well, if you are an individual investor, it's really hard to make money with very little risk if you invest in individual items. The first thing that you should do, probably is to invest in some ETFs, right? Now, I also want to point out that our program, the financial analytics program, and to some extent finance and financial engineering as well. So our programs are dedicated into placing our students into various different companies on Wall Street, one of them being hedge funds. Now, hedge funds, they specialize in that. So when first of all, hedge funds work with large investors. So you have to have a certain amount of money to open an account with a hedge fund, like, $100,000, $1 million, depends on the size of the hedge fund. Obviously, if the asset under management of the hedge fund, something of the order of billions, they won't accept small players. So you will have a much larger barrier of entry. But then how is the hedge fund judged? Well, they make a contract with you and they guarantee a certain amount of profit over a benchmark, over S&P, or one of
combination,
those, or a combination, whatever it is that
the hedge fund actually is the style.
Exactly. Depending on the style of investment, some of them invest in ETFs, some of them invest in ESG, bonds, whatever.
Yeah.
Now, what I want to point out is that the reason they can do that, the reason they can get larger returns over a particular benchmark is because they hire our students. So you have to have a degree, in a master's degree, a specialized degree, to be able to figure out what investments to do. And this is really not available to the regular students, right? Yes. So you have to take some of our courses to understand what is going on.
So yeah, definitely. So again, going back to talk about, so again, I highly recommend this docu-series called Eat the Rich, and I found it like very entertaining and then very informative at the same time. So one of them is actually the main message was, the people who get hurt, because the whole discussion was about Robinhood, which basically supposed to be the Robinhood, as we all know, gets money from the rich and gives back to the poor.
Well, not the firm, the original
character or
Yeah.
but that's the
The
concept,
OG.
because they wanted to popularize make it accessible to every investor, so they can actually easily access that investment. But then also there was a lot of things behind the scenes that investors didn't. So there's actually Robinhood basically will tax retail investors because they give you free brokerage account, and what they do, they sell your data to flash boys. Flash boys, what we mean is the high frequency traders, right? So those actually dominate in terms of what we call is, you think about I go to a supermarket or go to farmer's market. There's the dealer who takes money and basically able to bring commodities and sell it. And these actually will be working with the stocks, and they basically match between buyers and sellers. So there's something behind the scene. But the main message with the movie was actually anytime that investors, retail investors, actually those who get hurt the most, right? Because following the trend, but also it comes with the philosophy, because retail investors are tired of just they want to make money. There's also like the sentiment from 2007, 2009 that the banks got bailed out, and that created sentiment. And now you could see that actually COVID came and people were at home. So it kind of created that investment. So I totally kind of created that sentiment. So I totally understand the pressure. They want to make money quickly and fast. So it was actually multiple interesting podcasts. I think one of them was Wall Street Journal to the Moon. They had a sequence of discussions. So I recommend that as well, as a big fan of podcasts myself. But again, the philosophy was, call it the F it, like basically people like say, we don't care anymore. We're just going to put that money. And I hear stories about people put money in cryptos. Those actually did pretty well. But again, by the time people start knowing about this, right, it's kind of like gets too late. So they get the example for GameStop and AMC, which you would say that these businesses should be dead. Why actually these businesses should have such high stock valuation. And it was a very interesting way that these investors actually jump in these stocks. But the idea was not based on fundamentals or facts on the ground. The thing was based on the sentiment that we just want to get rich soon and quickly. But again, you can see that some people get lucky, but then the majority actually get hurt. And at the same time, the founders of Robinhood actually they like scoop about billions of dollars when they went for IPOs, and those are actually the rich ones. And I think that was an interesting perspective
Yeah,
from the docu-series. Right?
So I think so. First of all, one thing I want to mention is we've done a couple of projects in our program. Terminal. We do like in our programs we have a final project in FE and FA. And we've done a couple of projects where we looked into this, both the Wall Street Boys, the Reddit activity, and
Ape was done. That's what you call it.
I don't know. I wouldn't go that far.
But no, there's actually the website called Ape was done.
No. Anyway, we looked into crypto too. We looked into cryptocurrency investments, and we discovered a bunch of them that are scams, a bunch of scams. And we even discovered how they do it. But anyway, that's too wide a subject and going into a tangent that we should make that a subject of a different podcast. There's so much to say. But coming back to the investment.
Yes, so Professor, now that we saw a few topics like risk, inflation, and recession being around the corner, I would like to personally know that if I, let's say, have like $1,000 with me, what are the best stocks to invest that will provide low risk, stable gain for like a period of time, like a good period of time?
So fundamentally, you would say if we're going to be still existing in a high inflation period, so the whole thing that inflation affects stocks is a valuation, and we think about a very simple way. We always think about the way you can think about the value for stock is like imagine yourself going to a restaurant, right? The restaurant will give you five courses, right? And then you will say the price of that meal should reflect these 5 courses. Now the question is how much I wait for these 5 courses, right? So the longer I have to wait, right? You're not going to pay. Let's say if I wait 2 hours to get these 5 courses, I pay $100. But if I pay, the same price, but it's going to take me 10 hours to eat these 5 courses, right? You're not going to be as happy. And you think about it as how long I need to wait in order to consume these courses, right? So speaking as a metaphor. And that's how discounting works, right? We always think about how long I need to wait until I actually consume that. So the major stocks that actually been affected is technology stocks, right? Tech companies, growth stocks. And the reason is because you think about their courses, right, or appetizer is going to come much later in the future, right? So the longer you have to wait, right, and the higher inflation is, the more their value going to deteriorate, right? So imagine like you're going to eat something outside the fridge. So the more it's outside the fridge, right, the worse it's actually going to get. And I always use that as a metaphor in my class discussion, right? And that's how it actually happens, right? We always prefer getting something right now immediately, right? And if you want to wait that long, you want to get compensated for that. So there's been a lot of shift because of inflation. More investors actually going to companies that give you these appetizers immediately, right? So it would be more value stocks, for instance. You can think about Domino's Pizza is a good example of us. And actually, it's a stock that highly profitable and been outperforming despite. I'm not saying that hindsight's 2020, but there's another discussion with Danny Reynolds on Bloomberg business market business. I think it's called Masters of Business. And it was basically a discussion about Domino's. If you consider more value investing, you probably or think about from analyzing companies, check that out. I'm not making a recommendation about Domino's, but I think the shift that would be is if you try to be less inflation subjected, is you might consider investing in value stocks or companies that pay dividends, right? Because when you think about companies making money immediately, they will basically give it to the shareholders immediately, so you don't have to wait, years until we get these cash flows. So that's kind of like usually the typical recommendation. And we could see that the shift between value and growth stocks, right? So there we actually could see there's growth stocks been dominating for until like 2021, and then when inflation fears came, so actually we saw rotation going from growth to value. But again, it's easier to say after the fact, as they say, hindsight is 2020. Things get priced, markets are dynamics. It's a very difficult, but this is kind of like the mainstream recommendation would be. Yeah.
So I would say, I would add to this. First of all, I don't know. Dr. Majid, he's the expert with what to buy specifically and whatever. But in the light of the discussion that we had, that the lowest risk would be diversifying your portfolio and investing in ETFs. ETFs, exchange traded funds. So what these are is, in the US, is really interesting phenomenon. Basically, in the US, first of all, let me just start a discussion with there. I mean, beyond inflation, beyond anything else, keeping your money in the bank in the US is the worst possible thing you can do, because the US banks, they give you something like 0.02%.
0.01 in fact.
Yeah,
some banks.
that's ridiculous.
Yeah.
I mean, there's no country in the world where you do that, right? Only in the United States. Now, why is that? Well, why is that? It's really simple. They want to discourage you to take the surest investment there is, and that is put your money back and invest into the financial market. Because once you invest in the financial market, you're actually contributing to the economy developing. So all that money that's now with the bank that you invested in the stocks, all that money is going to force the economy to grow. So this is one of the key mechanisms, hidden perhaps, through which the United States is the biggest economic power of the world today, right? So now, basically, if I now don't want to put my money in the bank, well, what the hell do I do, right? What do I do with my funds? And one immediate thing is, okay, why don't we just install it in stocks? But like Majid said, I mean, this is kind of risky. I mean, you can, even if you invest in Apple, for example, which is one of the largest companies, the biggest cap in the world. If the CEO of Apple suffers a stroke tomorrow, which is something I can't predict, right? Then the stock of Apple that has absolutely nothing to do with the CEO just going to drop. And my investment all of a sudden is going to drop just because of that. So to avoid this, you invest in ETFs, exchange traded funds. So these are instruments that contain a combination of stocks. In the US, what they did is they came up with like indicators. So there is like a sector of the economy called utilities, for example, which contains all the companies that provides energy, oil, everything that has to do with energy. That's called utilities. So the utility sector, then you take the largest companies in the utility sector and you create a combination, like a portfolio that contains a multitude of stocks. That's called the index. And you don't really need to invest any money, you just call the index, and that index just kind of tell you about the activity of that particular sector. So if the sector is up this quarter versus last quarter, it means that investing in this sector, it's a good idea. So it's kind of an indicator on where to invest. Now, in the 90s, there were created ETFs that are tracking this index. So people were saying, okay, wait a minute, if this aggregate thing is going up, I want to buy this aggregate, but you can't buy the index because it's just an indicator, right? So instead, what you now do is you can buy an ETF. The ETF, exchange traded fund, it's something that tracks the indicator. It's supposed to be a one-to-one correspondence. So rather than thinking about which stock to buy, you would think about which sector to buy, which is a much simpler question because there are only 11 sectors in the United States economy. You can also invest into S&P 500. That's kind of an overall index that contains top 500 companies in the United States. There is an S&P 100, top 100. There's an S&P 200, which ironically, it's not the top 100. It's the 200 after the top 100. And then there is the Dow Jones Index, there is the Russell, there's a whole bunch of indices, and they're all tracked by ETFs. Not only that, but there is leverage ETF too. So the market is so diversified in the United States that it gives the opportunity, especially to these like small players that Dr. Siman mentioned, Robinhood. For example, normally in maybe 20 years ago, you would need to have an account, and the account would have to be owning maybe $10,000 with a broker to be able to trade. You won't be able to trade if you don't have $10,000 in your account. And now, anytime your account drops a certain value, you have to put more money into it. And now Robinhood and E-Trade and all these other ones.
So a good example, speaking of fraction investing. So I do allocate a small amount every day to Berkshire, right? So that's basically Warren Buffett's. And the fund used to actually be very exclusive. So you had to put large amount, and each share used to be $500,000. But now I put, for example, this is like private information, but well, I guess not private anymore. I put $11 every day I always joke that I give $11 to Warren Buffett. And everybody asked me, why $11? I said, because I was born in November, right? So I'm not doing as much optimization. So this is called passive. So you can actually do that every day. You allocate a certain amount, right? Again, speaking of not timing the market, so you can actually today, thanks to all these, technology enhancements, right?
It's like
and
a
more
modern
accessible.
piggy bank.
Yes. You can actually just and you can actually allocate that to in a certain way, right? Yeah.
More than piggy bank, yeah. But the problem is I was born in January, so I can only put
well, you can put 100 then. Or
I wasn't born in the month 100.
Well, you can say 100, right?
I can do it on the 9th. I can put $9 because I was born on the 9th of January.
There you go. So I think being able to invest fractions. I think so. Again, speaking that Professor.
So what is just let me just clarify because again you're a very fancy researcher. So what Dr. Siman is talking about there with the fractional investment. So normally in a exchange, if you go and trade with the New York Stock Exchange directly, you cannot trade one share. You need to trade the minimum unit is 100 shares of whatever. So what does that mean? Berkshire currently, there's two types of shares, right? Shares A and shares B. The expensive ones is what, 20,000?
No, it's actually $500,000.
What? Really?
Yeah.
So $500,000 for one share, right? So which means that the minimum amount traded is 100 times $500,000 times 500,000. That's 50 million. So one, right?
Good math, yeah. Good algebra, yes.
So one trade equals $50 million. So you would have to have 50 million in your account to even buy one share, right? So obviously not many people have that, even if they're big investors, that's a very huge sum. So today what the brokers do is instead of actually trading with other brokers, you're trading with your own broker. So he has a broker, like say Robinhood or E-Trade or whatever. And now what happens is the broker itself owns shares of Berkshire and then spreads these shares to its constituents. So it's capable for him to buy $11 worth of something that's in fact worth $50 million, which is kind of crazy.
Exactly. So it makes it more accessible. And I think this is one of the bright side of fintech. Again, we don't want to go to discussion. is Robinhood good or bad? If you're gonna watch that docu-series, the message was Robinhood's bad, but I'm not advocating that. I think still you want to trade with carefully, and I think that's basically, and also like these guys got compensated for innovating something. We see that,
Yeah,
Jeff Bezos,
I think it's very important to for this podcast to just realize this is a serious podcast.
Yeah.
So I'm a professor. I mean, my reputation, I'm supposed to be, mathematician, very exact. Siman, he's a PhD in finance, and he's a very reputable person. We're not doing this for sensationalism. So that's why our podcasts sometimes are pretty boring, because, facts are often boring. We don't look for sensational. We don't look for, and the documentaries that Dr. Siman is talking about, they have to be sensational, because nobody's going to watch them. I mean, would you watch a normal day in Warren Buffett's thing, and you see, let's say you have a movie, right?
Actually, I did see one of the documentaries, and I realized that he actually in the morning he gets his breakfast from McDonald's, and he said that he gets if the market is up, he gets the $4 breakfast, and if the market is down, he gets the $3 breakfast. So I know something.
But I mean, the point is, like, day by day stuff, it's kind of boring, right?
Yeah.
You would want to watch the day of Warren Buffett when,
Good thing we're drinking coffee. Without alcohol.
So, you would, alcohol would be good actually for this.
Yeah. That's good. Yeah.
Sorry. So anyway, the point I was trying to make is stuff that we are saying here, it's kind of, supposedly straight. And sometimes the straight stuff is pretty boring.